If you are a parent, this one is for you. In 2025, the child tax credit is changing, and the difference could mean hundreds of dollars more in your pocket, or losing out completely if you don't know the rules. The big beautiful tax bill makes some adjustment, and today I will walk you through exactly what's different, how it affects your family, and how to plan ahead for both 2025 and 2026 so you don't miss a single dollar. Hi, I'm Mia. I'm an enrolled agent, which means I'm licensed by the IRS to represent taxpayer. I have family, small business owner, and landlords save money and file their taxes with confidence. My goal is simple: make the tax code understandable and useful for everyday people like you. Let's dive in. Here, what actually changed in 2025 under the big beautiful tax bill. The child tax credit go from $2,000 to $2,200 per child under the age of 17. Starting in 2026, it will be indexed for inflation, so it should rise slightly year after year. But here the important part is not fully refundable. The maximum refundable portion is about $1,400 to $1,700 depending on inflation. The age limit have not changed. It's still only for children under 17, and there's a new rule. To claim this credit, both you and your spouse, if you are filing jointly, and your child must have valid work eligible social security number. Why does this matter? For a family with 2 kids under 17, that's $4,400 in credit in 2025. Compared to last year, $4,000, that's an extra $400 that can go toward grocery, bills, or school supplies. For family with lower income, the refundable portion means you can see money back even if you don't owe federal tax. And if you got a child who's turning 17 soon, remember the cutoff has not moved. You might only get 1 or 2 more years of this credit. Now, let's talk about phase-out rules. If your adjusted gross income is about $200,000 as a single filer or $400,000 as a married couple filing jointly, your child tax credits start phasing out. The thresholds are not indexed for inflation. That means as wages rise, more families will lose this credit unless they plan. If you are close to those numbers, think about deferring income, increasing retirement contribution, or shifting capital gains. These moves not only save for the future, but also protect your child tax credit. Let's go deeper with some bonus planning tips you can use for 25 and 26. First, double check your dependent's age. If your child turns 17 during 2025, eligibility depends on their exact birthday. So don't assume, so confirm before filing. Second, coordinate credit. So child tax credit is separate from the child and dependent care credit and the earned income credit. So you might qualify for more than one, which can stack into thousands of dollars in savings. Third, you want to plan across 2 years because the credit will be indexed for inflation in 2026. It might rise a little. That might change whether you accelerate or defer income and deductions. So planning across multiple years can add up to real savings. 4, make sure the social security number rule won't strip you up. Both parents and the child must have valid social security number. Mixed status family might lose eligibility if this requirement isn't met. 5th, if your kids are older, start pivoting toward college credits. Once your child turns 17, you lose the child tax credit, but you might qualify for the American Opportunity Credit or the Lifetime Learning Credit. So don't leave these on the table. 6th, think beyond refunds. Many families only focus on how big their refund is, but if your income rise too much, you might lose refundability. So adjust your withholding or estimated payments now to avoid surprises. And here's a bonus tip looking at 2026. If inflation pushes the credit slightly above 2,200, that extra amount can combine with inflation index brackets to create small but real advantage. So timing, income, and deduction across tax year could make the difference between keeping your credit. So let me give you a real life example. The Lopez family has 3 kids, age 5, 9, and 15. Their combined income is $120,000. Under the 2025 rules, they qualify for the full $6,600 child tax credit. Their tax liability is only $4,000, so they get the refundable portion as well. The total refund grow by nearly $2,000 compared to last year. Now compare that to the Kim family, who earned $430,000, filing jointly with 2 kids. They are above the $400,000 phase-out threshold, so their child tax credit is reduced by $500 per child. That's $1,000 gone, the money they could have spent with better planning. And if you are wondering how to run these numbers for yourself, I've got you 2 resources. First, my pro deduction shop on Etsy. That's where you can grab calculators and templates to track dependent, estimate credit, and plan your tax outcome in advance. So go to prodeductions.etsy.com. Second, AssetWiseInstitute.com. This is my website when I post guides, planning, strategy, and resources for family, small business owners, and landlords. Both links are in the description. Now I want to hear from you. If you got that kid under 17, drop your age in the comment. It's always fun to see how many families in our community will benefit from this credit. Plus, it's helped other parents realize they are not alone in figuring out this. So here's the bottom line. The child tax credit is now $2,200 per child under 17 starting in 2025. Only part of it is refundable. The income phase out remains fixed, and the new Social Security requirement is in place. It's not a massive change, but for many families, every dollar matters. With smart planning, you can hold on to this credit, boost your refund, and prepare out for your kids' age. If you found this helpful, hit like, click subscribe, and share this video with another parent who could use the tips. The tax code changes constantly, but I will keep you updated so you can keep more of your money where it belongs and with your family. Thanks for watching, and I'll see you in the next video. Mahalo!